Hey everyone, and welcome to Legendary Real Estate Services Real Estate Market Monitor for October. And last month we covered how the market was shifting gears. Now we're going to go into and show you how the market is accelerating really into that last leg of this seller's market. And really the overall implication is, does that mean we're racing over a housing cliff? So we're going to talk about that in this quick video. So to do that, we're going to look at a macro, micro, then macro level again. We're going to look at the big fundamental forces that are affecting the housing market nationally. And then we're going to chunk it back down to the Walworth County, Wisconsin area that shows how the market is shifting even further. And then we're going to scale it back out to look at what does this mean for real estate buyers, sellers, and investors? So let's get to it. All right. So this shows housing production since about the 1960s. And what I want to draw your attention to is right around the time of the financial crisis, the housing market crash here. So what happens for builders when housing prices are low or depressed, or there's a stunted growth in the economy? It's not profitable for them to begin construction. They have to wait till housing prices reach a certain threshold. That way they can make a profit after they've constructed made any real estate construction. So we saw the housing price or housing production start to ramp up, and then this flurry, and that flurry really coincided with the financial crisis. And that's really what created the perfect storm, not just the subprime lenders, not just the over leverage. It was also that we were in an abundance, an excess supply of housing units. We were in the hyper supply phase of the four real stages of the market cycle, with being recovery, expansion, hyper supply, which precedes a recession, which is what we saw after the housing market crash. So let's go to this chart. All right. So this really accentuates what I was saying. This is the housing supply. We had a huge ramp up in supply during the expansion phase, and then we reached a hyper supply peak. There was more supply in the market than there was demand. And what happens when there's not enough demand to meet supply? Housing prices start to dip. And again, we had the leverage going on. We had the subprime lending. That's what pushed it. We didn't just have an oversupply because of the subprime lending and the housing bubble. What we eventually saw a bunch of foreclosures and short sale, which is really what depressed the market, that pushed us from hypersupply into the recession. And the problem with that recession is, as prices were depressed, it doesn't make sense for builders to start building. So we haven't had the same level of building or construction to keep up with the new and rising demand that we're seeing. Because if you think of the population is exponentially growing, and so we need more housing units as that population grows. That supply was absorbed, and we didn't see a new supply because new construction didn't occur at the pace it needed to keep up with demand. So that comes down to 2021. As you can see, we are very undersupplied for homes. And that's really the nexus of the difference, besides tighter lending standards, of course. What's different now than the financial crisis? Oversupply, undersupply. So demand is real still to this day. We're just seeing some really interesting nuances with it. All right. To really drive what I mean home about the supply, the National Association of Realtors had estimated that we have a deficit of about 5.5 million housing units, and that includes single-family homes and different sized multi-units. Okay, let's chunk it down to our home area, Walworth County. We're going to look at three indicators that are really going to depict that acceleration out of the seller's market that I think is really more artificial than standard fundamentals, i.e., we're not accelerating out of a seller's market into a neutral market because we're entering hypersupply. There's some subtle nuances going on in the market, which we'll cover in a bit. All right, so last month, I was covering where we're at with the months of inventory. Now, when we have less than 4 months of inventory, we are in a seller's market. And basically, months of inventory, if we stopped having any homes come online for sale today, how long would it take for the market to absorb the entire inventory? That's months of inventory. So it's a proxy of where the market demand, supply and demand is. As you can see, we reached our peak between January to April timeframe. Then we started seeing that shifting gears, and we really ramped up our shift out of the seller's market last month, and that's continuing. So from 2.7 last month to about 3.17. So we are a little bit above 3 months. Once we hit that 4-month threshold, from a basic supply standpoint, we're going to be in a neutral market. Now, days on market. Now, this is good. Days on market is oscillating around 40 days. So this means homes really aren't sitting on the market. They're still being scooped up. So demand is still strong. They're still absorbing. So it's a confirmation there's still buyer demand out there. We went from about 34.9 to this month about 41. So again, like I said, we're still oscillating. This is a really good number. Now, this is different. Inventory. We saw that interesting spike of active listings above new listings and sold listings. And it was at about 3,900 last month. Now it's at 5,400. That is a huge spike, which confirmed what I was saying in the last video. So we're getting less new listings. We're getting, a little bit less sold listings as well. So what that tells us is that our inventory, while demand is still there, there's still an inventory that's just sitting on the market, not being absorbed. And you have to ask yourself, why? Well, before we get to there, looking at median prices, because this is going to add to that puzzle piece. We went from $289,000 as a median home price sold to $179,000. So that's a huge drop, which again, we're going to dig into why. This is why. The sale to original list ratio. Now, when it's above 100, that means people are offering over asking price. And as we saw from that feeding frenzy earlier this year, people were overpricing their homes, and then there were bidding wars offering above overprice. So that's what was happening. But then the market hit a I'm done point, and it started slowly coming down at a very healthy rate. When it comes below that 100, that means that prices are not being sold above those asking prices, and we're seeing that huge drop. It was 98.9%, a very steady, healthy drop, to sort of a little bit of a plummet to 97. So what's happening in the market is that we're seeing a lot of price reductions from sellers because their homes aren't moving. They tried to overprice it. They wanted to get, over top dollar, and reality is setting in that if they want to move their home, they're going to have to price it a lot more realistically. And at the same time, buyers they were over that frenzy. So now we're seeing people ask for 5, 10, even 20 or more under what the list price is. And now that's starting to be entertained because we don't see that bidding war, feeding frenzy. So that's a huge shift. The buyers have spoken. And so that's changing the dynamic in the market. Now, why is buyer demand softening? Well, you probably have, a few of your own conclusions, but these are what we found in our research. Really the number one being the uncertainty of COVID. With the new Delta virus, how is that going to shut down really the economy the way it did? It's still an uncertainty on where that's going to be. So people are, buyers are potentially holding off on their search for a new home until we have some certainty of what's going on with the economy. And also the market was intimidating. That feeding frenzy, the overpricing, the overbidding, the bidding wars, a lot of buyers, they knew it was just out of their budget. They didn't want to play that game. It was just an intimidating market to be in if you're looking to buy at fair market value, not buy too high and then have to worry about now what's going to happen to this property if we do have some sort of national housing issue with prices. Okay, it is still a seller's market. So there aren't enough homes. So if there aren't enough homes, then if you're looking, this is one of the biggest purchases you'll make in your life. Are you going to settle? I wouldn't, and many other buyers aren't either. So there's not a lot of homes to pick from. It's just the waiting game for the right home. And also, where are you going to live after? If you sell your home today, will you be able to find a comparable or better or ideal home? Where are you going to go? So a lot of buyers who are sellers are in this limbo state of where am I going to go after? And so that's causing a lot of softening of demand. Finally, there are buyers that have been in this market hunting a home for a long time. They've made offers, they've been competing in the market, and their offers have just been rejected. And so it's tiring for a lot of people. So that's why we're seeing buyer demand softening. It doesn't mean that there isn't demand. It's just that demand is just fatigued right now, and maybe they're just waiting for a little bit more certainty before they get back in the game. So what does this mean for us? Okay, it means we're still in a seller's market. However, demand is softening, but we're not exiting a seller's market because we're going into hyper supply and eventually recession. We're seeing this softening of the seller's market just because demand, while still there, they need a break right now. We're not looking at the same housing bust, again, because we're not over leveraged. We're not doing subprime loans. We don't have the same amount of supply in the market that we did the last time around. So we're not looking at a housing price bust per se, that recession in the real estate market cycle. Now, it doesn't mean the economy can't see or go into another recession. And if that does, though, a lot of experts are saying that housing prices, they might dip, but we're not going to see the crash because we don't have those fatal fundamental flaws in the market, which was really the leverage, the subprime lending, and the oversupply in the market. So if you bought a home and we go into recession, prices might soften, but they will still hold their value and then bounce back up eventually. It'll be a small dip, not catastrophic, is what's likely to happen. The market is nearing that threshold of a neutral market. And like I said, I think it's an artificial neutral market just because of, the fatigue buyers have. But it's a tough time for sellers. Why? Because sellers, you're not going to get the same top dollar, which is a bit tough. That's feeling that you left money on the table by not taking action too soon. For whatever reason that was, you're not going to get top dollar. And so you're going to have to price your home at fair market value, which is fine anyways. Buyers, it's a tough time because, again, it's still a seller's market. So it's tough for you to find homes that you want, and the prices are still elevated because of the feeding frenzy that we had. Now, if you're a seller that's still on the sideline and you want to still take part in the seller's market, it's still a good time. But like I said, you're not going to be able to price it with these exorbitantly high prices unless you really have a unicorn of a home. Then you can get away with it. But outside of that, the market has spoken. We're going to want to have to price it at fair market value if you want to move your home within a certain time frame. If you're a buyer, keep looking. Don't give up. We're starting to see more inventory. Prices are normalizing, so you don't have to worry about the huge spike, the feeding frenzy, the bidding wars, getting outbidded the way we did earlier this year. Don't give up. Just keep looking. When the right house comes along, it still behooves you to take action. Now, that all being said, there are a few wild cards. The first one being money supply and also inflation. So money supply, with quantitative easing after the financial crisis, we saw this huge surge of money supply. We saw that surge just grow exponentially with the COVID crisis, where the feds were injecting money into our economy. They were printing money, and that is not without consequences. Obviously, it's led to inflation, but more importantly than that, because there's so much more money, it costs more to buy the same amount of goods because of a devaluation of the dollar. That's what happens when we have an oversupply and we keep printing money. It devalues the dollar, which is why we're seeing, these huge crazy rises in prices, is because there's a lot more money supply out there. It's not just inflation and demand, the artificial demand from COVID, it's that money supply. So we're going to want to keep an eye out of that, because at some point the piper has to get paid. We just don't know what it's going to look like. We're in this economic petri dish playing with market forces that we've never played with at this national scale. So we're going to want to keep an eye on that. If any of you are aware of what inflation was like in the late 1970s and 80s, hopefully we don't see that kind of inflation that's almost crippling, but you never know. It's something that we want to keep an eye out. Inflation was about 1 or 2% earlier this year. It's at 5% now. We haven't seen 5% since 2008. And the question is really, is it going to continue to climb? And if it does, are we going to be looking at the inflation that we saw in the 70s or 80s? Maybe, maybe not. Again, we got to keep an eye on it. All right, interest rates. So the Fed has been going back and hemming and hawing about this for a very long time. They want to raise interest rates, but we know that they're not going to raise interest rates until they've stopped their the bond buying purchase program. And that may take about 9 months, 12 months from when they actually decide to start doing that. So before they raise interest rates, they're going to have to stop or taper their bond buying program. So when they raise interest rates, it's going to cost more to borrow the same amount of money. Now, non-prime mortgages. This is another name for subprime mortgages. Those never went away. Shocker, right? We still have subprime mortgages, but they're not as prevalent. Fannie and Freddie Mac, they're not getting involved with them, but FHA is, so we have to be careful, but it's still such a small slice of the economy. It's not as massive and prevalent as it used to be, but it's still out there. Same thing with CDOs, the collateralized debt obligations, which is what caused that huge over leverage, that fiasco in the overnight market that almost crushed our economy. Those are actually becoming more popular now. You'd have thought they learned, but it's not prevalent, but we still have to keep an eye on it. So hopefully, it doesn't get to the point where they're too big to fail again, right? So we'll keep an eye on that. Obviously, COVID is still going to be an ongoing wild card that remains to be seen. And Evergrande. So this is a Chinese real estate development company. It is China's second biggest economy, and Evergrande, I think, is one of, if not the biggest companies in China. And they are going under, and the government is not bailing them out for political reasons. And there's just a lot of uncertainty about what that is going to do to the global housing community. Because of globalization, is it going to have this ripple effect and pull everyone under with it? The chances are unlikely. Why? Again, because we do have real demand, because we're not over leveraged and playing with fire like we used to. We will likely see or feel repercussions, the ripple effect, but the sentiment is, we're going to brace for a little bit of a ripple effect, but it's not going to be a tidal wave that takes us under. But it's still definitely something to watch. What we have to think about is how all of this, the money supply, inflation, Evergrande, COVID, and eventually interest rates, all of that is going to combine. What will that do to the entire system? Is it going to create another perfect storm? I don't know. but that's what we do have to watch out for. But again, the real estate fundamentals are still economically sound and strong. So it likely won't be the same crash racing off the cliff like it was last time, but it doesn't mean it won't affect it, and it won't have other consequences on our economy. So it remains to be seen, and we'll keep you posted on what we find. Now, I realize, again, this is a video. However, if you do have any questions, there's my email. Definitely reach out, shoot me an email, and we'll discuss it, or we'll create another video. I'll be happy to talk to you offline. If you're looking to buy, sell, or invest, my partner, Chris, he is phenomenal. He's been in the market for 30 years now. He's run big, huge real estate brokerages in this area. He would be more than happy to help you. So go ahead and email him or give him a call. And from all of us at the Legendary Real Estate Services team, thank you for stopping by, and we look forward to seeing you on the next video. All right, thanks and have a great day now. Bye.